You're thinking about buying, but you need to sell your house first. You don't want to end up in a situation where you put your house on the market, but then you don't find something that you want to purchase. How do we mitigate that risk? Stick around. This is the video for you. I'm going to tell you exactly what to do. I'm AJ with the Emerald Group right here on the Emerald Coast. We are doing videos every week from Pensacola to Panama City Beach and everywhere in between. So if you have any questions or interest in any of those areas, go ahead and hit that subscribe button and ding the bell so that you get notified every time we do another video. We have been getting calls, texts, emails, Facebook messages, etc. And we absolutely love it. For all of you guys that are thinking about buying or selling in the area, please, our contact information is here on the screen and you can get a hold of us whichever way you prefer. So let me talk to you about this great program that we've recently started using. There's a specific lender that has this actually there are a couple of lenders at this point that have this program. So I'm just going to go into the program and not so much the lender at this point. Okay, this is called a home swap. So it's kind of a lot like what it sounds like. You're basically like using the equity from the house that you already own to purchase another house without having to sell the former prior to purchasing the latter, if that makes sense. I'm going to go into it. It might be a little bit fuzzy right now, but don't worry. I'm going to give you all the information that you need to make a decision on whether or not this is a great avenue for you. So who is this loan option good for? This is for somebody who needs to sell in order to qualify to purchase, right? You need the funds from the equity in that house that you currently own to put down as a down payment to qualify for another purchase, or just to get rid of that debt so it doesn't show up on your debt to income ratio when you go to purchase. And it's important in today's market and many markets to not have to deal with that contingency in order to close, in order to create a competitive offer, right? Because if you're interested in a house, chances are someone else is interested in it too. And if their offer is the same as yours, but you have a contingency that you have to sell your house in order to be approved and they don't, obviously the safer choice is to go with the other offer. So we're trying to mitigate that risk here. So what does this process actually look like? So the first thing that you're going to do is you're going to get an approval, a non-contingent approval for a conventional loan that is backed by Fannie Mae or Freddie Mac, right? The second thing you're going to be approved for is a secondary loan, which is basically a loan from the equity in the property that you already own. So it's essentially a bridge loan. This bridge loan is what's going to be used to create your down payment and potentially any funds to do work to the house that you need to sell in order to sell it, and also up to 6 months worth of monthly payments so that that's not on your debt to income ratio. Does that make sense? So 6 months, you don't have to worry about payments on it. You've got your down payment and potentially funds to do work on that property. All of that is in a second loan, completely different from your loan to actually qualify to purchase the property you're interested in. So keep in mind that this is all dependent on the equity in the property that you need to sell. So however much that amount is, that's what's going to determine how much you can use towards all these different things, you know, down payment, etc., all these things that I just mentioned. Once you've qualified for both of these loans, you'll get your standard pre-approval letter without a contingency of needing to sell, and you're able to go home shopping with us, right? We're able to go look at houses, put in non-contingent offers, and go ahead and secure a contract to purchase. And it's just your standard 30-day closing time period. It doesn't have to take an excessively long time. There aren't any hidden dangers, essentially, that we wouldn't already be aware of when working with a different form of loan. There aren't any different things that are going to kick you out of your pre-approval that wouldn't kick you out of a pre-approval for any other type of loan. So essentially all the standards of a conventional loan still apply for this. One of the greatest parts about this is that you can go through the entire buying process and close it and then move all of your stuff from your previous home into this new property and then get that house ready to list and sell. So maybe you needed to repaint the whole thing. It's a whole lot easier without any furniture in it. And it's also easier to get pictures and to market an empty house. So you have a higher probability of selling very quickly because other people can picture their own furniture in there, right? And you're not worried about anyone being in your house because there's nothing in it anymore. So it just creates this like really great environment for both the purchasing aspect and the selling aspect. Now, once you list that property and then close the sale on that property, that's when you're going to pay back that bridge loan. So it's all going to come from those funds. What if your property takes a little bit longer to sell? Well, remember, you've got 6 months worth of mortgage payments already covered through that loan. So you're good, really, like for the most part. It could take a little while, but as long as it doesn't take that full 6 months or beyond that, then you're pretty solid. What say if the worst case scenario happens and it doesn't sell within that 6 months? There are some lenders that when they create this home swap loan, when they use it, the way they structure it is they go under contract with you to state that they will purchase your property that is under contract to sell if it doesn't within that first 6 months. But they're only going to purchase it up to 85% of its value on the market value. Now, this is a part of the contract that does get done. You will have to sign this about 2 weeks prior to closing on the purchase of your property. Now, let's say that your house doesn't sell for 6 months. After you close on the purchase, your property to sell doesn't close within the first 6 months. This lender will go ahead and purchase that property at 85% of the just market value, and they have their own algorithms of how they determine what that value is. But let's say while in the process of that, someone else actually comes through and offers you more. There's no penalty at that point for actually selling it to the buyer with with a higher offer. So that would be a plus because their goal is not to purchase the property. Their goal is for you to sell it and them to get reimbursed for their loan. But these are some options. So at a minimum, you're not stuck paying 2 mortgages at one time. So let's go back and talk a little bit about the terms of the loan for the purchase of the property. You're able to do either a 15-year loan or a 30-year loan. They do require a minimum of 5% down, and you have to have a FICO score of at least 620. If you decided that you wanted to pay the loan off early, then there are no penalties with that, which is great because, well, you pay a lot less interest if you pay things off early. The interest rate of this particular loan is going to vary just like any other conventional loan. So it'll kind of follow market trends. Now, the interest on the equity loan from the property that you're going to sell, though, that 6 months worth of mortgage coverage, that's 0% interest on that loan. So that's great. Let's talk about some of the fees that are associated with this that you're going to have to come out of pocket for. So while that bridge loan is going to cover your mortgage payments on the property that you need to sell, it's not going to cover things like HOA fees, utilities, etc. So you're going to have to continue to maintain the property even though you're no longer responsible for the mortgage. Anything that has to do with the new property that you've just purchased, all of that is going to be on you. So, your mortgage payments, your utilities, your HOA fees, etc., all of those things will be on you as well, obviously. Keep in mind when using this program, you will be required to put your house for sale within 45 days of the closing of your purchased property. So there's a little bit of a timeline there. So in the event that you need to do some repairs or something, you really need to be ready to go so that you can get that property on the market as fast as possible. Plus, you don't want to risk, running out of time. So what fees did the lender charge? Well, they charge a 1.25% fee. It's like a convenience fee, essentially, of the purchase price of the property, not on the sales price of the property that you're going to sell, but on the purchase price of the property. They also charge a $14.50 administrative fee. What kinds of properties can you use this home swap option for? Only primary residences. So this isn't going to help you if you're in the middle of like a 1031 exchange on an investment property. So this can only be This can only be used for your primary residence. And let's say the seller of the property that you're wanting to purchase wants to do a lease back period to help to give them time to move or something like that. Their house isn't going to be ready. You do have the ability to do that, but only for up to 14 days. Some other properties that this can't be used for are modular homes, mobile homes, or properties that haven't been built yet. There isn't a construction perm loan in this option at this time. Let's say you have so much equity in the house that you want to sell that you could potentially pay cash for the new property just based off of the equity. That unfortunately isn't going to be an option with Home Swap. The max that you can put down is 20%. They want you to hold a mortgage with them. Now keep in mind, there isn't a penalty for paying it off faster, but at least initially you do have to hold a mortgage with them of at least 80%. There are also, typical stipulations like on a conventional loan. If you don't make a down payment of at least 20%, then you will have to pay for PMI, private mortgage insurance. Hopefully this video has been super informative for anybody that's in a position where they're considering buying and selling at the same time and maybe a bit nervous about trying to buy while we're in like a cooler market. Obviously, if we're in like a super hot market, this isn't so much of an issue, but as it's cooling off a bit, or maybe, in another market, maybe it's a little bit slower, who knows? This would definitely be a viable option for someone who's a little bit nervous. If you guys have any questions about this video, go ahead and comment down below with any questions that you might have. Otherwise, we'll see you at the next one.